Hey, welcome back guys to my world of stocks. My name is Ali, of course, and welcome back to my tier list series where we take the stock portfolios of famous investors or traders and we rank their 10 largest stocks from best down to worst in a tier list ranking system. And if you're not familiar with what a tier list is, it's just a sort of ranking system made up of different tiers from best at the top to worst at the bottom, and we do it to visually organize the stocks that we're looking at and rank them in comparison to each other, again from best down to worst. And I also take into consideration the broader market as well, but it's mostly a comparison of these stocks in relation to each other to see which stocks I like the most and which stocks I like the least out of the portfolio. And of course, I also give my quick opinion on each stock as we go through in case there's anything on there that is worth taking a closer look at in the future as a possible investment for myself. But these videos are always a lot of fun for us, and if you want to check out past episodes where we looked at investors like Warren Buffett and Bill Gates and even Jeremy from Financial Education, you can find past episodes up here down in the description or at the end of this video on a clickable card. But in today's episode, we'll be taking a look at Michael Burry, who most of you probably recognize from the movie The Big Short, where he was played by Christian Bale for accurately predicting the 2008 mortgage crisis leading to the Great Recession. Now, in the past, his investment firm called Scion Asset Management held a variety of different stocks, but in the last quarter, they actually trimmed their portfolio down to just only 7 stocks. So we're gonna go ahead and run through them, and I'll give my quick opinion on each. Okay, as always, our ranking list will consist of 5 different tiers from S down to D, with S tier being the very best of the stocks of the portfolio. The A tier will be kind of above average, the B tier will be mostly average, kind of middle of the road, the C tier will be below average, and then the D tier will be the very weakest stocks of the portfolio. And the rules are that there needs to be at least 1 stock in every single tier, and there can be no more than 4 stocks per tier so that we spread everything out more and have a clean and more evenly balanced ranking so that we can clearly see which stocks I consider to be better than the others. And all of my opinions on these stocks will be based on today's prices and looking out into the future as a slightly more growth oriented long-term investor. Okay, now the last time that Scion had to report their holdings was for the third quarter of 2019, which was released by the SEC on November 14th, 2019. So this information is based on that date. And at that time, the portfolio was worth almost $60 million. And coming in at stock number 7, that's going to be Vectra, ticker symbol NVTR, at less than half of 1% of his portfolio. And it was actually a brand new position for him in the quarter. Now, this is a medical device company that went public in 2016 as a spin-off from another company called Great Batch, which I've never heard of either company myself. But apparently Vectra is a medical device company that specializes in neurostimulation, and I believe their first flagship product was a spinal cord stimulation system called Algovita. In any case, this is by all accounts a completely failing penny stock, as they used to trade for over $20 a share as recently as 2018, but have since crashed all the way down to just 14 cents after announcing that they will file for Chapter 11 bankruptcy that could technically still involve a sale of the company or even assets like their Algovita system. I'm not sure if this is a result of that, but I couldn't find any valuation metrics on Yahoo Finance, although they have technically been growing their sales by very high rates with revenue growth of over 50% last year, but they've also been losing tens of millions of dollars of free cash flow in each of those years. So I honestly just have no idea like what's going on with this company, but I'm assuming that Burry was trying to time the bottom and perhaps wasn't aware of their plans to file for bankruptcy. In any case, they absolutely belong in the D tier, as I doubt that we'll see any other stocks on the list that is in worse conditions. By the way, I will just note that at less than 1% of Burry's portfolio, it barely affects him at all, and that's probably why he gambled on it. Okay, coming in at stock number 6, that's going to be Canadian Natural Resources, ticker symbol is CNQ, at just under 7% of his portfolio. And this was another new position for him in the quarter. Now, this is a Canadian oil and natural gas company. In fact, they're currently Canada's largest independent oil and gas producer. And when looking at their stock, they seem to be pretty volatile, which is common for these type of energy stocks. But despite most oil and gas companies really tanking this past year, they actually saw their stock climb by over 22%, although they are still down a little over the last 5 years. That recent rally though has left them trading about 30% higher than the sector median on a forward PE basis. That may be justified though, given that they've actually grown their sales by pretty high rates in recent years, although they are expected to be flat in 2020, but have also been able to squeeze out profits recently with over 4 billion Canadian dollars of net income over the past year at a time when oil prices have been mostly falling, which is not something that a lot of oil and gas companies have been able to say lately, so it's kind of impressive. And all the meanwhile, they continue to pay a pretty attractive dividend of close to 4% with some decent growth potential on it as well. Still, I know very little about energy stocks, and as more of a growth-oriented investor myself, I'm just not a big fan of the volatility of oil companies and would prefer those with brighter looking futures like renewables to actually invest in myself. So for me, this is still a stock that doesn't really attract me, so I'll have to put them in the average B tier for now in case we run into any other stocks that I happen to either like more or dislike a little bit more. Okay, next up here we have Bed Bath & Beyond at stock number 5 at over 13% of his portfolio, which is also a new position for him this quarter. And I'm sure you guys have heard of this one. They're a retail chain that sells home products for mostly the bedroom and bathroom, but they also offer other goods for things like the kitchen and so on. And I don't know if you guys have ever shopped there, but it's actually a pretty nice store and the selection is usually pretty good. Although to be honest, I personally use Amazon for almost all of my home shopping needs these days, so I have concerns over how sticky their business is going into the future, and as more of a long-term kind of growth-oriented investor, I've just never really felt the need to really research them in depth, although they do technically have an online shopping website that I guess would help mitigate at least some of that. In any case, their stock has actually climbed in recent months after recovering from a bottom, which is probably what Burry was hoping for, as it's a new position for him, so he was likely trying to time the bottom, but that ultimately leaves them up over 30% so far in 2019. However, if we zoom out to get the long-term picture, we can see that the stock has actually cratered by nearly 80% over the past 5 years after seeing stagnant sales for years that are also expected to decline over both of the next 2 years, which is also coming off of an already declining year in 2018 as well. I would honestly be surprised if Burry holds on to this stock very long, as they are clearly being disrupted, and the fact that they opened their stores on Thanksgiving for the first time in history is just another sign of them trying desperately to get customers to walk through those doors. They do technically have a low forward PE ratio of only 8, but their PEG ratio is negative, as their EPS is expected to decline by 4% a year over the next 5 years, and that's even after having already declined by 28% on average over the past 5 years as well. So I have to put this one in the D tier, as there's just no way that I'd feel comfortable investing in them long term, but I will put them ahead of New Vectra, as they have at least avoided bankruptcy. Okay, that brings us to stock number 4, which is going to be Sportsman's Warehouse, ticker symbol SPWH, at over 14% of his portfolio, and this is an outdoor sporting goods retailer similar to Dick's Sporting Goods, which you may recall that them, along with Walmart, have decided to stop selling firearms, which analysts seem to be thinking that this will benefit Sportsman's Warehouse and help them maintain some of their healthy growth rates that they've been seeing for years now, which is kind of impressive, especially for a retailer with physical brick and mortar stores. Their profits have really struggled in the past though, with EPS growth over the past 5 years being relatively flat, but analysts seem to be very optimistic about their future potential, as they expect EPS growth of over 20% over the next 5 years on average, which leaves them with a very attractive PEG ratio of less than 1. All of that optimism has led to their stock actually climbing by over 80% in 2019 after having fallen off a cliff in previous years, as they are still up by only 5% over the past 5 years as a result. Again, I'm not a fan of traditional retailers, but I can understand why sporting goods stores are still alive, given their more complex product offerings that many people are likely not comfortable buying online, as well as the recent boom that they're likely seeing from gun sales. Still, it's just not a stock that gets me excited about the future, so I'll have to put them in the B tier for now, and to be honest, I cannot decide between putting them ahead or behind of CNQ, as I think Sportsman's has the better valuation, but CNQ actually pays an attractive dividend. But since I don't really like either one of them, I guess I'll keep CNQ in the front, since I would at least be able to collect a dividend from them, but honestly, it's really a tie for me. Okay, and finally, we have a stock that I actually like over the long term. In fact, this is a stock that I actually plan to own myself as soon as they dip a little, and that's going to be Google. Ticker symbol is GOOG at over 16% of his portfolio. And this isn't a company that needs any introduction. They are the largest internet search provider in the world. They have a growing cloud business. They own YouTube, which is what you're watching this video on right now. And all of this has led to them commanding the most digital advertising market share in America, even ahead of Facebook. And that's a market that I fully expect to get bigger and bigger over time. This has led to very strong performance for their business, as they literally did over $136 billion in sales last year and are still finding ways to grow at around 20% a year. You just can't beat that type of performance. Ultimately, though, this has led to a pretty high valuation, as they trade for a forward P ratio that is 26% higher than the sector median, while their PEG ratio is close to 10% higher as well, given that their stock has shot up by over 150% over the past 5 years. But given their amazing business that in my opinion is only going to get bigger in the future with all of the valuable data that they continue to collect, I can already tell that Google needs to be our S tier stock of the day, as I highly doubt that any other stock on the list even comes close to Google, at least in my opinion. Okay, having said that, there are still two stocks left that we need to look at, and coming in at stock number 2, that's going to be Tailored Brands, ticker symbol TLRD, at over 21% of his portfolio. Now, of course, this is another retailer, since it seems that Michael Burry really loves his retail stocks, and they are famous for being the parent company of places like the Men's Warehouse and Joseph A. Banks, among other men's tailored and formal wear providers. Just like most other retailers though, Tailored Brands is currently in the gutter, as their stock has crumbled by over 60% in 2019 alone and close to 90% over the past 5 years. And just like most of the other stocks on the list, I'm guessing that Burry is hoping to catch the very bottom and ride it up on a recovery. I'm not sure when or if that'll ever happen though, as their sales have been dropping for years and are still expected to continue doing so even into the future. Granted, they do seem to have an extremely low valuation, so I can see why Burry thinks that it's a good time to gamble on the stock, but as a growth long-term investor, there is no way that I could trust leaving my money in this stock over the long term. Truth be told, I'm surprised their business isn't very sticky, given that I'd expect anyone buying a suit would actually want to try it on in a physical store before purchase, but for whatever reason, they just really seem to be struggling to grow their sales, maybe because of decreased mall traffic. But in any case, I'll have to put Tailored Brands down in the D tier as well, but behind Bed Bath and Beyond, since they seem to have slightly better performance. And coming in at stock number 1, it seems very fitting that GameStop, ticker symbol GME, would be at the very top of his portfolio at over 27%, given how much I already dislike all of the, almost all of the stocks on this list. And GameStop has been one of those over the years that I just haven't seen any kind of future potential in, given how the entire gaming industry is moving to a more digital future, and GameStop keeps trying to sell used physical games in brick and mortar stores. This chart here from Statista illustrates just how bad it's getting for physical game sales, as they are completely eclipsed by digital. Don't get me wrong, I still purchase most of my games physically because I like to collect them, and I'm also not a fan of this new kind of digital trend, so I would actually love to see video game stores like GameStop survive, but my personal preference has zero value when objectively looking at these changing consumer trends. Not to mention that even when I do buy physical games, I find much better deals at places like Best Buy and Amazon, and I just never really see very many good deals at GameStop. So I don't even shop at GameStop, which is already kind of a bad sign for them, at least in my opinion. Anyway, the result for GameStop has been them having to kiss their profits goodbye over the years, as they have now lost over $1 billion in just the past 12 months alone, while their sales are also expected to plummet by almost 20% this year, and then another 4% the year after. I actually wouldn't be surprised if they see an uptick in their sales next year or the year after because of the launch of the new Xbox and PlayStation home gaming consoles, and given that Burry added this position this last quarter, he might be taking a chance on that as well, and it may be already working as the stock has climbed over 30% in the past 3 months. But this is ultimately a stock that Burry has had positions in and out of, so I wouldn't be surprised if he sells somewhere around here. And keep in mind that the stock is still down about 50% in 2019 and over 80% in the past 5 years. Again, I wouldn't be surprised if the stock is super volatile over the next couple of years because of the new console launches, but over the long term, there is no way that I could trust this stock. And so for that reason, I'll have to squeeze them into the D tier as well, and I'll put them in front of Tailored Brands but behind Bed Bath and Beyond. And because we never put any stocks in the A tier or the C tier, I'll have to bump up Canadian Resources and Bed Bath and Beyond by default. So that leaves us with Google in the S tier, which is like the clear stock that needs to go there. Canadian Resources in the A tier, which kind of went up by default. Sportsman's Warehouse in the B tier, as I kind of just see them as average. Bed Bath and Beyond in the C tier, which was bumped up by default. They really belong in the D tier in my opinion. And then GameStop, Tailored Brands, and New Vectra all in the D tier, which they absolutely belong in my opinion. Obviously, I'm not a big fan of Michael Burry's portfolio, but hey, that's okay. We can all have our different opinions and, of course, our different investing strategy. Which, to be fair to Michael Burry, he's clearly much more of a short-term kind of value-oriented trader, whereas I'm more of a long-term growth investor. So he's really like the polar opposite of what I am. So I think it's natural that I would rank a lot of his stocks very low and actually only move a couple of them higher by default. But that doesn't mean that he can't make profits off of his strategy. If he is able to time the bottom on a lot of these stocks accurately and kind of ride back up a little bit of a bounce back recovery, then he can actually make a lot of money, as we kind of saw with some of the stocks that have climbed by a lot in recent months that have been falling over a longer term kind of picture. But for me, that's a strategy that is very risky, and so it's one that I try to never really mess with. It'd be very, very rare that I would try to do something like what Michael Burry seems to be doing. But anyway, what do you guys think about my rankings for his portfolio and his stocks? Do you agree with my overall assessment, or would you make any changes? Let me know down in the comment section below. And as always, I hope that you guys enjoyed this video, and if you did, make sure you hit the like button and subscribe if you haven't already. But thanks again for watching. I really appreciate all the support, and I'll catch you guys in the next one. Oh, and by the way, let me know which investors you'd like to see me do next down in the comment section as well. Anyway, I'll see you guys later. Take care. Bye-bye.